Our first speaker this morning, if we can get your attention, is Sherri Seiber. Sherri Seiber is the president of Fran Fund. With over a dozen years in the industry, she is an expert of small business funding and is a regular speaker at franchising events across the country. She has been recognized by Entrepreneur Magazine as one of the 100 Women of Impact by Franchise Journal, as one of the most influential women in franchising, and every year since 2018 as one of Global Franchise Magazine's top 20 women in franchising. So a real powerhouse. I've heard her speak several times and she is excellent. So please joining me in welcoming Sherri.
All right. Well, this is, I think, my third time participating in this great summit, and thank you to Richie and Alan and the rest of the folks at Manning Fulton or Fulton Manning for inviting me. And I also am happy for the opportunity this morning to meet some of you when we did the roundtables. I think that was a really good start to the morning, because in that opportunity, I got to sort of see a little bit about what the scope of the room is. And so what we have here is, for those of you that haven't met each other yet, you know, you've got folks that haven't decided to franchise and don't have the first one sold or open. You've got people that just started franchising and have them some sold and they're getting them open. We've got some with units already open, et cetera, et cetera. And so what I'm going to talk to you about today is funding solutions for your candidates. They've given me very generously an hour to talk here. I'm pretty sure that my slides are 15 to 20 minutes, so I'm going to invite you to ask questions that I don't answer during my presentation portion, and let's make sure that you leave here with an understanding of what it's going to take to get your precious candidates funded with your brand. So, tiny bit about Fran Fund. We've been around since 2006. We've been recognized in Entrepreneur Magazine. They started doing a survey of top various things, but top funding providers to the franchise industry about 5 years ago, and we've been number 1 or 2 every year since then, voted on by at least 500 or more franchisors. My husband and our CEO is currently the supplier, rising chairman of the supplier forum for the International Franchise Association, which, for those of you that aren't familiar with the IFA, I suggest you spend a little time on franchise.org finding out what that association does for you and your business. We're part of VetFran, which is very important to try and help our veterans get into the franchise businesses because they're known to be great operators. I'm from Durham, North Carolina originally. We went to Chapel Hill, so nobody hold that color blue against me if you are not preferable to Carolina blue. But we live in Fort Worth now and we operate nationally. So how do we get our franchisees funded? The answer to that question is dependent, of course, on a lot of things. Unfortunately, there is no single bullet. There is no answer that is necessarily applicable to anyone, and it's going to depend on the size of your system, the size of your opportunity financially, and of course the individual. But everybody talks about, and we get calls every day wanting either a grant. Is the government going to give me a grant because I'm a woman? Guess what? Women are not minorities anymore. Can I get an angel? Who do I call for an angel investor? Well, I think we all know the answer to that. Maybe God, but anyway, venture capital, partnerships, those things are out there. Private equity is out there big time. I think there's actually a talk about that at some point. But I wouldn't start my business with the intent of finding a private equity partner. There's asset-backed funding, which of course is equipment leasing or securities-backed funding. In other words, you can take your wealth portfolio and get a loan against that of marketable securities. That's one way of getting quick money. Then there's debt funding, and I think we're mostly all familiar with credit cards and home equity loans and bank loans. That's commercial lending and SBA loans. And then of course self-funding, which is cash or the rollover for business startup, which I will elaborate on shortly. So let's talk about SBA lending. That's what most folks have either heard about or they just say, I'm going to go to my bank for a business loan. First of all, the SBA, Small Business Administration, is an arm of the U.S. government that happens to be very effective. There is a very successful part of the government. Despite how it sounds when you hear somebody from the SBA talking, and I'm sure my banker friends in here will agree with me, they don't actually lend money. What they do is they provide a guarantee to the lender to incentivize them to take riskier or less comfortable loans into their bank. So that's definitely a small business. That's a first-time business owner. That's a startup, possibly expanding from 1 to 2 to 3 to 5 units. That's why the SBA loan was created. So if that loan should default, the SBA will help the bank repair their loss so that, again, they're not losing money on these deals if they've done the loan correctly. That's a big sentence that I'll expand on another time. So the SBA goes, really it's as low as $50,000 up to $5 million, but it's very difficult to find a lender these days that will do an SBA loan for under 100, and even under 150 can be a little bit of a challenge. What FranFund does is, we are not a bank. We do SBA loan consulting. Actually, we do consulting with the candidate for taking a look at their financial situation and telling them what options they have based on their current financial situation. So what we've done is we've amassed a portfolio of lenders across the country, and Michael Byers Bank is one of them, who we understand what their appetite is for what kind of deal. Not every bank likes every kind of deal, and they might like it on Monday, Wednesday, and Friday, and on Tuesday and Thursday they won't approve it. So we have to have various lenders across the country that understand the value proposition of franchising and that are willing to take a look at those loan opportunities for that business. So what are your candidates going to need to obtain an SBA loan? Now, I have to say, generally speaking, that all of these different criteria are somewhat fluid. But if you think of them as buckets, credit score, and a good favorable financial history, 680 plus is preferred unless you are a owner of several franchises and now you're going to open your 15th one. The bank's going to let you slip on that 680, probably down to 640 or so. But if you're a first-time business owner or first or second unit, 680 or above, and a favorable credit history. You're going to typically need to have a cash injection, personal cash injection of 15 to 20%. As little as 2 years ago, the banks were asking for 30%, but as the economy has grown, they have become more comfortable with lower numbers, and so it's hovering right around that area right now. For collateral, they typically want your house pledged as part of the collateral. Personal assets, and that's not grandma's china or your 65 Chevy. That is actual home or some property that they could use as collateral. And then one of the things we were talking about just at the table I was participating in here is burn rate. Now that's a term that most people aren't completely familiar with, but when you're assessing, and you guys should not have to do this for your franchisees, that's what you're sending them to us for, but burn rate is an important number because that takes into account the loan payment, or if there's a lease, if they have to lease property, they've got their loan payment, their lease payment, their personal expenses. That cost is going out every month regardless of how much income is coming in. So the lender is going to want to see that they have cash coverage even if they have little to no revenue, or perhaps, so your candidates are going to do projections based on your FDD, and they're going to need for those projections to be aggressive enough to let the lender know you are serious about running a business, because a lot of people try and do very conservative projections, so it's a low hurdle. Well, the bank says, if you don't have confidence, neither do I. I'm not giving you any money. So that's one of the things we sort of coach people up on too. But the burn rate's an important component of that. And so depending on how long it takes for your business, your franchise typically to start to break even, you're going to start to need to see burn rates that cover that period of time and a little bit more. So there are occasions when the bank does not require personal collateral, but I don't think anybody in a startup franchise situation will find that to be true. If you have an extremely financially strong borrower and it's the third or fourth unit, they will use the business as collateral as opposed to personal collateral. But really, when it gets right down to it, all the lender is looking for, it's very simple. How are you going to pay me back? Don't care what you do otherwise, but you better have some plan that you can illustrate to me on how you're going to pay back this loan. And so that's where the collateral comes in. Right now, we're not going to spend any time on this, but SBA loans are taking 45 plus days to close, and a large part of that typically is if there is real estate required, then that ups the time, because you can't get the loan until you actually have a piece of real estate nailed down, because the bank wants to know what they're actually lending to, and so that can take up to 90 days. But it's another reason why when we're working with candidates, we start working with them maybe before they've made their final franchise selection, or hopefully early enough in the process that we can sort of, if they tell us they want to be in business in January, we sort of back up the calendar and say, okay, we're going to need to get your funding in place by X date to make sure you're ready to go when you think you're ready to go, and there are no final surprises. I think I have a slide about interest, but we'll see. So anyway, that's what we do. Is, again, we're not a lender. We work with people to find their solution. And for SBA, a lot of people have bought a house. Getting a mortgage is not anything like getting an SBA loan. Possibly the only correlation is you need about this much paper for a mortgage and about this much paper for an SBA loan. So the amount of documents you have to fill in are approximately the same, but a mortgage is something. It's this. The bank knows where it is, they know how to get it, they know what it's worth. If you default on it, they know they can go and repair their loan. For a business, they're dependent on the borrower to get out of bed every morning and to go run that business and to make good decisions and to follow the franchise process. So when they're assessing a candidate's ability to get that loan, they're looking for more than just the money in the bank, or the equity injection, or their credit score. They're looking for also, does this person have anything in their background that prepares them for this type of business ownership, whether it's a home health care or a restaurant or whatever. So we have been very successful with what we do, because most people, they go to their local bank, and this may be where they have their checking account or even a savings account or something like that, but the bank doesn't know them. And so you may go and meet with somebody in the lobby, and any of you lenders that want to call BS on me, please stand up. But they go into the lobby and they say, hey, I want a small business loan, and the nice looking young man or woman at the desk says, okay. And so the person leaves thinking that, yeah, they're going to do my loan, but all they've said is, yes, we do loans. We're not necessarily doing one for you until you go through all the process. So And again, like I said in the beginning, not every lender likes certain types of businesses. They each have a kind of a particular appetite for either loan size or loan or business type. Some aren't comfortable with startups, some are, et cetera, et cetera. So that's how we add value. We actually do a process where we do, without doing a hard credit pull, a pre-approval process that we have. It's very similar to what banks use to pre-approve. So when we hand somebody a pre-approval, we have said we're confident that they can find a lender that will do that loan. So that allows somebody that's going through the franchise investigation process to move forward with confidence and take that worry off their hands. So again, not to disparage the local banks in here, because those are very important to you, and a lot of you folks that are from around here, you've got at least 3 banks. There are 2 or 3 banks in here that I met earlier, and you should consider them. But local banks, again, they may have a particular appetite. They may not want to do a loan under $750,000 or under $350,000 or whatever. And if your brand doesn't fit their criteria, they're going to say no. But that does not mean that the candidate is not viable. It just means they need to talk to a different bank. So we have, because of having about 50 banks in our portfolio, when we give a pre-approval, we've got a 99% success rate, as opposed to walking in a local bank and getting it done. So the thing that we were addressing at my roundtable this morning was how are the increases in prime rate affecting and impacting SBA loans. So the next statement's kind of an eye-opener for some people, and I don't blame you, because if you're not familiar with the lending world, you wouldn't be. But SBA loans specifically are typically prime plus 2 3/4. There are exceptions where some lenders will often offer some period of time fixed rate, but typically they adjust quarterly. Now, right now, you've been hearing up, because the Fed is trying to correct some mistakes they may have made over the past couple of years, and so they're trying to control inflation. And so we're up around the 9% mark. But as much as rates go up in an SBA situation, they also come down. And so we've had great success talking to candidates about, doing some simple math. What's your loan payment at 6%, 7%, 8%, 9% over the 10-year life of your franchise agreement? And is it really worth waiting a year or more until interest rates come back down to start your business? You've got lost opportunity cost in there and everything, and most people get that. And those rates, I do firmly believe that they will come back down. Not sure when, but I hope it's sooner rather than later. We also talk to candidates about what else is there besides SBA. There's unsecured lending, and for certain price ranges, this is a great option. And also, if there are reasons that certain people can't get an SBA loan, they could be, a felony or some other disparagement on their credit. But if they have pretty much good credit, there are unsecured lenders out there. It's not the cheapest money you will find, but if you have a business plan and you're burning to go get that thing open, this might be a good solution. We don't do that in-house. We have a partner that we refer people to, and had great success with that this year. And a lot of people have used it, even up to, let's say, $250,000. ROBS stands for Rollover for Business Startup. Who in here has heard of ROBS? Okay. You're going to be shocked, those of you who have not heard of it. This is pretty cool. ROBS stands for Rollover for Business Startup, and it's the IRS that coined the phrase ROBS. Very clever, right? But what it is it allows you to use qualified retirement funds to invest in your own business. It's not a distribution, it's not a loan, and it's been legal since 1974 when the ERISA Act passed. And that, just as a milestone in the history of pensions and that kind of thing, is when pension, it went from pensions to you having an individual 401k. That is when that happened. And I'm going to explain to you how this works. The benefit of this is that when you use these funds, and by the way, qualified retirement plan means either an IRA, a 401k from a former employer, not a current employer, a 403b, blah, blah. There's about 20 different types of retirement plans. And as long as it is not with your current company, it's typically a qualified plan. When you use a 401k rollover, or just a rollover, that is a huge way that many of the almost 800,000 franchise units in this country have been funded, either as the total funding for the business, in which case you'd start with zero debt, which makes achieving that burn rate a little better, or as the equity injection for a loan. It's been very effective. When you do this, and I'm going to get to the guts of it here in a second, but think of it this way. If you call your broker, your wealth manager this morning and say, hey, here's $100,000 cash, go buy me $100,000 worth of Apple stock, okay? At the end of that transaction, your 401k now has Apple stock, and Apple has your $100,000. You don't have any idea exactly what Apple's going to do with that $100,000, but you hope they make a prudent investment that will increase shareholder value. That's the exact same thing that's going to happen when you use your 401k to invest in your own business. At the end of that transaction, the business operating account has cash that can be used for any legitimate business expense, and your 401k, which you will have as a result of how this process works, will have shares of stock. Now let's say on that day one, we're going to issue them for $1 a share. So you've got 100,000 shares at $1 a share. And then that's your 401k, and you're going to pay attention to that just like you do your current one. But you're going to go off, your franchisees are going to go off and run their business. They're going to pay themselves salaries, they're going to grow, they're going to spend marketing dollars, they're going to blah, blah, blah. And this 100K worth of stock, well, next time a business valuation is done, maybe it's worth $1.25 a share. Maybe it's worth $1.50. And then through the 10-year life of your franchise agreement, it's going to continue to grow. And at the end of that agreement, 10 years from now, let's say that, and I'm just being, let's say conservative, but the 100,000 is now $1 million in 10 years. You're going to put that $1 million back into your 401k and then take distributions from your 401k as you have to anyway once you reach 72. But the way this works is a couple of caveats that give people, one particular that gives some people heartburn, especially if there's any accountants in the room. You have to have a C Corp when you do this structure. It can't be an LLC, it can't be an S, because both of those are coming from the same pocket as the owner. C Corp is a corporation for the benefit of all employees without discrimination. So a C Corp can have a 401k for their employees. So what happens in this scenario, the initial investor would use their 401k, but we'd set up a new 401k that all employees could start contributing through payroll deductions, and so could that owner. And it has to be through a C Corp for that structure to be allowed. So we create the C Corp, we create the new 401k plan that again is available for all qualified employees, and usually that's a full-time employee that's been there a year. That's our typical, but that's adjustable. And then the funds are moved from the current 401k IRA, wherever you've got it, into the new 401k, and then there's the stock exchange that happens that I explained earlier. So again, at the end of that transaction, you have not taken a distribution of your $100,000. I think I've got a slide, there you go. We'll use $150,000 in this example. You have not taken a distribution, because if you take a distribution and you're under 59.5, you will pay your ordinary income tax rate, and we just chose 30% for this example. I don't even think that's a real rate, but it's pretty typical. You'll pay 30% in taxes plus a 10% penalty if you're under 59.5. So in this example, starting with 150, you'd have a check for 90,000, but you wouldn't have to have a C corporation. You wouldn't have a 401k that you could offer your employees, which sometimes can be a big incentive for managers to stay on if they're able to contribute to a 401k as your employee. If you do the transaction though, you have the whole $150,000 to start with. So don't be thinking though that the IRS is not looking out for their money. They're not letting you get away with that, but you're in partnership somewhat. You could view it this way. You're in partnership with the government. So you're using their eventual tax dollars. What you hope is that by the time you get to the end of this transaction in 10 years, or if you decide to buy it out sooner or sell it or whatever, that you have put yourself in a lower tax bracket than when you started. And so when you do start taking distributions, it'll be at a lower tax rate, plus you'll be over 59.5 and you won't have the 10% penalty. So again, this is a very standard way of funding franchises in this industry. And I think it is extremely pervasive these days. It's still very popular. And even though I was telling the table earlier, back in 2008, people were saying they had a 201k instead of a 401k. I don't think the losses are quite that significant now. But some people have questioned, is this the right time, or should I wait for my 401k to go back to where it was? And again, we're counseling that, okay, look at it and determine whether delaying the start of your business 18 to 24 months on the gamble that your 401k will go back up is worth not starting the business today and seeing if you can regain the value in your 401k by your hard work and the growth of your business. And so people make all sorts of decisions. Lately, they've been leaning more towards, let me get started. Then I'm in control. I'm the one getting up in the morning and making the donuts or the tacos or the burritos or whatever we got. So this process, one of the beautiful things about the Rollover for Business startup process is credit score doesn't matter, and for some people that's important. It's access to capital. You don't have to get approval from anybody if your funds are qualified, and it takes less than 4 weeks to get that done from engagement to completion. The IRS oversight, though, this program is governed by the IRS and the Department of Labor. Why the Department of Labor, you may say? The IRS is understandable. They want your tax money no matter what. The Department of Labor is interested because if you do have a 401k that's for the benefit of all employees because you have a corporation, then they want to make sure those employees are offered the ability to participate. And so part of the annual filings that we need to do has to be done by a third-party administrator. And that's a business that FranFund also does. But that's what the IRS requires in order for you to be able to access those funds, is an annual reporting and a few other compliance issues. Somebody's very enthusiastic over there. So I think I already covered. Well, performance of the stock market. I mean, this is the same as the performance of your 401k, right? Those of you who keep your eye on your 401k every day, some days you're walking on sunshine and some days you're ready to, jump off a building. So I don't recommend looking at it on a daily basis if you have a wealth manager. That's your wealth manager's job to do that. So FranFund can also help with unsecured loans, refinancing, securities-backed lines of credit, and just to reiterate on what that is, we don't do that, but you should be able to go to your wealth manager and say you've got a portfolio of stocks, bonds, mutual funds, cash. They can evaluate that portfolio, and you may, and let's say blue chip stocks, you might get, 80% of the value. Other stocks, you might get 50% or less or whatever, but they'll evaluate that portfolio and give you a loan against those marketable securities, because they know that if they need to call that loan, they can go and sell them on the open market. There's home equity lines of credit, and what I'll say about that, and again, we don't do those, but we will include those in the conversation we have with your candidates, because sometimes that is the last solution, but we recommend it as not the last solution, but as the rainy day fund. So some of you earlier, I was saying that 8-month period for a new franchisee, the 8 to 12-month period seems to be kind of a touchy area with a lot of new franchisees. They're either overwhelmed with the opportunity or underwhelmed with how things are going or whatever, and cash flow starts to decline a little bit, and all of a sudden the marketing department comes out with some great campaign that's going to turn it all around, and they don't have the money to put in there. Okay, well, that might be when you consider a home equity loan. We don't recommend starting out with that, because then you've tapped out your rainy day fund. So anyway, there's also fleet leasing, equipment leasing, and all of that is business specific. There are no like overarching equipment programs for every brand out there. The way we operate, we basically, our consulting service is no charge until you actually engage us for something. And so our funding consultants talk with folks about sort of evaluate their financial picture, make some recommendations. If it is for an SBA loan, we have some recovering bankers on staff that we have them do the next level of evaluation. And then, again, we back into the calendar when they need this, and we make sure they get funded when they need it. Just a little bit of bragging. We had a lot of good reviews. This is my business development team, my funding consultants, and then we have franchisor relations folks in this picture. One of the things that we help with, rather than, it's a more personalized experience than going straight to a bank. And again, I love banks. We need banks to do our business, so no disparagement whatsoever. But we build a relationship with these people. We're not trying to sell them anything. We're just trying to help them realize their dream of business ownership by providing funding solutions. So we can validate the franchise. Once we start working together, if you're a franchise business and we go, oh, it's Dank Burritos, we know them, what a great business they are. They've got some successful franchisees going. You're going to love that. And so that helps, because any candidate, and those of you that are already had some units open, you know that in the initial process until they decided to become a franchisee, they went through a lot of emotions. Most of them started with the word F, fear. They're waking up in the middle, and if they're not waking up in the middle of the night screaming at some point in time, they're probably not as serious as you think they are. But fear is one of the big factors. Spousal sabotage, I'm sure all of you know about that. And the spousal sabotage doubles if you mention the word retirement plan. You're going to touch our retirement plan to do that business? I will divorce you. So a lot of times we try and make sure we have spouses involved in those kinds of decisions, so they know we're not just pouring that money on the ground. There's actually a plan for it, because that can be a really big thing. The other thing I'm going to skip through this. These are two funding consultants that, in case you guys wanted to refer to us, but let me just talk about a couple of things now that I've gotten through this. I was saying earlier, and it bears repeating, your first 10 to 20 franchisees are going to be with you for a long time, either as a success story and a validator in your FDD, and those are your performers that you're going to send potential new candidates to, and they're going to espouse the fabulous value of owning a whatever it is, or you're going to have failures that you will have to disclose in your FDD that people will be asking about and that lenders will be interested in. And failures are not a gold star for your brand, because when you set out with these first 10 to 20 franchisees, you want them to be financially strong. You want them to be able to weather the storm of COVID or of interest rates rising or of whatever else is going on, another election, God help us. you want them to be able to weather whatever those storms are. And if they do have, specifically if in their failure, they've also defaulted on an SBA loan, that gives the franchisor a black eye. And for every default, the eye gets blacker and bigger. And so you as a franchisor want to protect the reputation of your brand, not only from a validation point of view, but also from a proving to a lender that this is a good brand and one that they need to get behind. Because to us, you either have, and most of you are in this situation, you either have strength of brand, and so that's a brand that's 25, 50 or more units out there with a demonstrated system with FDD that shows an item 19, and all of the financial performance is indicated, the highs, the middles, the lows. That's a brand that a bank can look at and say, they've demonstrated that their franchisees are successful. And so in that case, the borrower may not need to be the financial rock star that they would have to be if the brand has 0 to 5, 10 units, because in that case, the bank has to judge the person. So when you're judging the person, and again, the number one thing they want to know is, how are you going to pay me back? But then they have to make sure that that person has enough cash, or they need some kind of outside source of income or some kind of savings they can tap into if their burn rate starts to increase faster than their projections. So all of these things are a factor. And so if I had to recap back to the, I did that. Can I get the very first, third slide, I think, somehow? Sorry about that. Next, please. One more, please. Oh, one more. There. I mentioned buckets earlier, and I didn't finish that analogy. If you think of the SBA loan qualifications as buckets, they either need to be all full, or if one's way overflowing, another one can be a little less than full. Okay, so you have to balance the candidate's financial performance and their financial history and their ability to repay the loan with kind of considering all of these factors, along with the age of the franchise, along with how many units are out there. In other words, people are usually surprised, well, what's the magic bullet? How do I get a loan? How much cash do I need? How much do I tell franchisees they need to plan for? These are all factors that are independent or dependent on your particular business, your industry, your time to break even, and all of those different factors, which is why we need to do analysis on every one of them. One more thing before I start taking questions. If you, as a franchisor, have not already established a relationship with a local bank, and by establish a relationship, I mean you have your personal checking, savings, whatever there, you have your business accounts there, you have potentially wealth management there, or whatever, as many things as you can do with that bank, and then you at some point should have a banker that is interested in your personal situation. That is somebody that you can share your franchisor performance with and say, hey, this is year 1. I got 3 franchises this year. These are my projections. Next year I'm going to have 10 and blah, blah. If you keep them going, then you may be able to establish a line of credit that you will need as a franchisor, which will be very helpful in your business going forward. Even if you don't tap into it, the fact that you have it makes lenders more comfortable with loaning to your franchisees. If you're a franchisor with no money on your balance sheet, then definitely the lender is not going to consider the franchise as part of the evaluation of the candidate. Does that make sense to everybody? All right. Who's got a question? Yes, ma'am. So what happens is you agree on a sales price with the buyer. Best practice is to have an evaluation done of the business. Now, because your stock in your 401k is not on the S&P or the Dow or whatever, not on the stock market, you have to have a third-party valuation company come in and assess the value of that business. So that's one way of assessing your stock value before you put the business on the market. But after you put the business on the market, if your valuation says you're worth $1 million and the buyer says it's worth $1.5 million, it's worth $1.5 million, right? Okay, so you get paid for the business, so you're gonna pay off all your creditors, you're gonna sell off all your furniture, fixtures, blah, 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 and you're gonna pay off your shareholders. And if the 401k from the company is still the 100% shareholder of your business, you're gonna put those funds back into the 401k, pay that stock off, and so now your 401k hopefully has done better than Merrill Lynch. Oh God, is anybody from Merrill Lynch here? Sorry, has done, and then you're going to start taking distributions as you would have had you left it there to begin with. That's one scenario. There's a few thousand different ones depending on, but that's a general good overview of how that works. That makes sense? Now, if you're sitting there thinking, but if I grow my business from $100,000 investment to $1 million, I want some of that money in my bank account. Okay, well, what you should have done prior to the sale is buy some of your stock back. And unfortunately, if you want to buy your stock back, you're not buying it back at $1, or maybe you are, but you got to go get a valuation done of that business and value that stock that we issued at $1 a share. Hopefully it's worth $2 or $5 or 50 cents, whatever it is, but that's what you'd have to pay to buy back some of that stock. But then when you do sell, you're getting whatever percentage after you pay off your shareholders. Let's say you buy back 50% of the stock and you keep 50% of the stock. 50% goes back to the 401k, 50% you get taxed and pay taxes on immediately. So you know that, or maybe you don't know, after the age of 59 and a half, you can take distributions from your 401k, however much you want. You just have to pay your ordinary income tax on it. You don't have to take any of it, or you can take however much you want up until 72, at which case they apply a math equation that only rocket scientists can perform, and they tell you how much you must take from your 401k every year they call them RMDs, required minimum distribution. And they are based on your age, your heir's age, moon phase, I don't know what, but so let's say you may have to take, and it could be 5% or 2%. It could be a small amount, and the older you get, the more they make you take. So your tax implications are not a problem, because you don't have to take the distribution until either after 59 and a half, you voluntarily take some, or 72, they start making you take required minimum distributions. So you only pay taxes when you actually take a distribution of the funds. Mm-hmm. No, you don't. You have to pay off your shareholders if you sell the business, because
play videos in the background and watch uninterrupted. Try
well, and depending on what percentage. Okay, maybe this clears it up. If you use your 401k, the $150,000, and that's how much your business cost in total. That was your initial investment. And so the 401k owns 100% of the stock. When you sell the business, you must pay 100% of the proceeds back to your shareholders, which is your 401k, which is you. If you have bought back some of the stock over that period of time, you've bought 50% of the stock back, then you will pay you personally 50%, and you will pay the rest of the 50% to the shareholder, which is your 401k, which is still you, but the IRS sees the two things very differently, right? The IRS sees your cash receipt as an immediately taxable event. They see the return to the 401k as non-tax or deferred taxable funds until you take a distribution. Is that helping? Right. Tax deferred until you take it out of the 401k. Well, first of all, if you, I'll get to your question. Just, or you want to add something to this? Okay. So the 401k is sponsored by your corporation. Once you sell the corporation, you have to, the 401k is finished, right? So you're going to, oh, maybe I didn't finish that. Okay, my bad. You're going to pay the shareholders off that are in the 401k. So now that money's in your 401k, but you need to roll that into an IRA. So now it becomes an individual retirement account. My bad. Sorry. But thank you for that forensic analysis. It adjusts quarterly based on Wall Street Journal Prime, and the loans typically are Wall Street Journal Prime plus 2 3/4. That's the SBA portion, 2 3/4. And right now, that's making it about 9%. There are some banks that are offering some portion of that rate fixed for some period of time, let's say a year, 2 years, 3 years. And so then you'd pay that 9% for 3 years and then let it start adjusting after that. But the borrower doesn't do anything. They just get a new payment book, and all of a sudden the payment's gone from $2,000 to $2,200 or something like that. It can also go to $1,800 and it can also go down. And again, I do believe that once the country gets a little situated, that it will start to go back down in the other direction. Okay, good question. It is not a self-directed 401k. When I say you have to have a C Corp to run a business when you do this process, and that's because you have to offer your employees the ability to participate in the 401k via a payroll deduction. They can't, you don't have to offer them to buy stock in your business, but they have to have their own account. But okay, you've got $250,000 or $500,000, it's in an IRA, right? Okay, you can leave $250 in the IRA and move the other $250 into the newly created 401k that's sponsored by your new corporation. Okay, that clear it up? Yes, ma'am. That's correct. is when she no longer works for the hospital. Well, if she's not going to use her 401k, then it's independent. Go ahead. Most companies don't, they allow you to take a loan. So you can borrow out of a current employer 401k $50,000 or up to half, whichever is less. So in other words, $50,000 is the max. So if you had $100,000, you can borrow $50. If you've got $60,000, you can borrow $30. Okay, so that's to be taken in. There are some rare companies, and I've seen some things these days when companies are offering, golden umbrellas or early retirement or whatever. They'll have people be able to access retirement funds before they've worked out their complete, whatever the cycle is. So different situations. But when we're, yes, ma'am. I think we finished that answer, didn't we? Okay. Perfect. If it's an IRA, it's easier to move the money. What happens with 401ks is that companies usually have some process that requires paperwork, and sometimes they send a paper check. Has anybody seen a paper check lately? They send a paper check by U.S. regular mail to the new 401k holder. And so those kinds of things hold up the process. If you've got an IRA, your biggest problem there is if you have a wealth manager, your wealth manager is going to lose their ability to manage your wealth if you move that money out of there. And so a lot of times they will say, that's a crazy process, you shouldn't do that. That's risky. So we encounter those kinds of objections, but and when you're considering this process, if you look at all of your funds, all of your assets, your balance sheet, your personal financial statement, some of your money is pre-tax and some is post-tax, but which part of that money is not retirement money, right? When you retire, you're going to use all your money. So it's just this process, if you think of it as a ability to use some tax-deferred funds with no penalty up front, it's very appealing. So, yes, sir. Okay, so the reason the IRS allows this process is that you are a corporation, a C Corp, which is for the, that's a non-individual beneficiaries type situation. So you have a C Corp that is sponsoring a 401k, like most Fortune 500 companies, they have a 401k for their employees. So they're letting people do this process so that you will offer your employees and yourself the ability to contribute back to the 401k. An LLC is a self-serving entity, so is an S corporation. So for those two entities, when you file your taxes, typically you're filing personal and business all at once. That is a situation that the IRS would not approve of, because then they can't guarantee that the funds are being managed for the benefit of all employees equally, without discrimination. I think I've about run out of my time, so I can easily be reached, or you can go to my website. I'm happy to answer any other questions by email or phone, or send up a flare. And I thank you all for your time and attention. I appreciate this opportunity. I Appreciate the folks at my tables earlier that I learned something from every one of you, and of course, Richie and his team. So thank you very much.